Here's a question for you. How many ways can you actually make money from your investments? Well, most of us think you only make money from stocks and other financial instruments in one of two ways: when the price goes up or when you get a dividend. Some of you might be expecting me to say, hey, there's a third way. But let me assure you, it goes beyond that because there's several ways that you can generate income using a portfolio. They each come with different risks and returns, but they offer the same thing: steady, reliable, and predictable cash flow, which makes it perfect for longer term or retirement portfolios. And stick with me because by the end of this video, you'll know exactly which strategies might fit your style best. I'll cover the most effective ways to generate income and see how each one compares to the others in terms of risk and return. Let's get into it. Now, before I dive into specific strategies, let's get on the same page. An income generating strategy is an approach that focuses on instruments that offer passive, recurring, and safe cash flow over capital appreciation. The goal is to establish a consistent and reliable stream of income that can be used to build wealth, provide financial stability or freedom, or cover your living expenses without withdrawing too much of your capital as is required by retirees. Investments that provide income include dividend stocks, government and corporate bonds, and even some option strategies, all of which I'll cover over the course of this video. In other words, we're not just chasing the next hot stock here, right? We're going to be building a money machine that pays you whether the market is up or down. All right, so let's kick things off with the simplest and most popular strategy, and that's dividend investing. Dividends are a portion of a company's earnings that it pays out to shareholders on a per share basis. For example, let's say a company pays $2 a share annually. That means shareholders get $2 per year per share that they own, as long as they don't sell the stock. Dividend payout schedules and amounts depend on each company. Some pay quarterly, which is the most common, while others pay twice a year, and others even pay monthly, like Realty Income or AGNC Investment Corp. Now, when talking dividends, there's something called yield, which compares the annual dividend you receive against the stock's current trading price. And this is expressed as a percentage. So for example, that same stock that pays $2 a year, let's say trades at $100 a share. It means if you buy the company at $100 per share and you receive the dividend, you're getting a 2% yield on your investment. But you might be thinking, the higher the yield, the better, right? Well, not so fast. Yields are based on a stock's trading price. So if a stock falls, the yield might look higher on paper, but that's not always a good sign. In some cases, the company may be paying more than it can realistically afford, which could lead to a dividend cut or even a complete stop. That's why yield alone isn't enough. A company needs to have stable cash flow and consistent earnings to make those payments sustainable. Think of it kind of like giving a child an allowance. If the parent has a stable job with a reliable and consistent income, and if the household expenses are kept under control, well, they can give the child a regular allowance. The more money the parent brings in, the higher the allowance can be. However, if the parent loses their job or unexpected expenses arise, well, that allowance might be reduced or stopped altogether, and that is how dividends work. So always consider the company's earning stability, payout ratio, cash flow, and dividend history, including its growth, to judge whether the income is truly reliable. Bottom line, dividends can be a steady income stream, but you want quality over quantity, and chasing yield alone can get you into trouble. But here's where it all starts to get interesting. Not all dividend stocks are created equal. Take, for example, companies on the S&P 500 Dividend Aristocrats Index. These are S&P 500 listed companies that have paid increasing dividends for at least the last 25 years. And yes, if a company has been growing their dividends for more than 2 decades, it means they probably have a higher degree of reliability. Companies included these lists are AbbVie, Abbott Labs, Archer Daniels Midland, and over 60 more. Now, there's other better-known companies in the Dividend Aristocrats list, but the reason I separated them is, well, they intersect with the next group of stocks, and those are the Dividend Kings. These companies have increased their dividends for 50 or more years straight. Imagine this for a moment. 50 years of weathering the many economic downturns, market crashes, inflationary cycles, and shifting business landscapes. I mean, over the last 50 years, we've seen the rotary phone, the DVD, cassette tapes, VHS, and other once ubiquitous things come and go. These Dividend Kings, they've outlived them all, and that's the kind of consistency that long-term investors want. Companies on the Dividend Kings list include Coca-Cola, Johnson & Johnson, and Procter & Gamble. And then there's also Dividend Zombies, and no, they're not dead companies that pay dividends, if that even makes any sense at all. Dividend Zombies are companies that have paid dividends for 100 years straight. No pauses. That said, they don't necessarily have to increase their payouts for the full 100 years. That's why not all zombies are kings or even aristocrats. And speaking about yield, let's talk about some of the highest payers out there. Aside from these long-term dividend growers, we also have REITs and business development companies, or BDC. Because of how they're structured, these companies are required to pay out at least 90% of their earnings to shareholders, which, you may have guessed, often leads to higher yields. The drawback with REITs and BDCs is that they don't get to keep much of their profit, so they don't have as much left to reinvest in their businesses. So how do they raise capital? Well, many of these companies raise capital through debt or equity financing, which can dilute existing shareholders. And that usually means slower growth, or in some cases, no growth at all in the stock price. In short, REITs and BDCs can be fantastic for income, but these companies don't tend to increase their dividends like, say, the Dividend Aristocrats. So if you're after long-term reliability, look to Dividend Aristocrats and Kings. If you're chasing yields, REITs and BDCs can give you more income, but they often trade growth for payouts. Now, before you go looking for stocks with the highest dividends, there is an important reality check. And it's the one thing about dividend stocks. Even those companies on the Dividend Kings and Dividend Aristocrats lists, they're not risk-free. The stock's value can and will fluctuate over time, and the company may cut its dividend payments due to business hardship. Investing in dividend stocks with reasonable yields offers medium returns in exchange for moderate risk. The higher the yield, the higher the risk. So the lesson here is stability beats excitement. The most sustainable income streams come from companies that can actually afford to keep paying you. The other type of income that's available is interest income. And that leads me to a question. What if you could lend money to the safest borrower on the planet and get paid interest for decades? Well, the easy answer is invest in Treasuries. These are debt securities issued by the US Treasury that last anywhere between a month for T-bills to as long as 30 years for Treasury bonds. They essentially serve as a way for you to lend money to the United States government. And with that debt comes interest. Let's take the long-term ones, for example, the Treasury bonds as an example. The US government currently pays bondholders a fixed interest rate, and today it's around 4.8, 4.9% annually for the 30-year bond. The bond value itself will go up and down over time, but at maturity, you'll be paid the par value, which was the initial value of the bond when it was issued. The payments are called coupons, and they represent the income that you get when buying the treasuries, and they're paid twice a year. And here's the kicker. They're not one of, if not the safest investments around. Unless the US defaults on its debt or ceases to exist in the next 20 or 30 years, both of which are extremely unlikely to happen, you can expect your coupon payments in full and on time. Treasuries won't make you rich overnight, but they do give you safety, stability, and a predictable income. And another problem? Locking up your cash for 30 years might feel like forever. So what's the workaround? Well, that's where bond laddering comes in. Bond laddering means buying bonds with different maturity dates. As each bond matures, you take the proceeds and roll them into something else, another bond or maybe a stock or something else. So for example, let's say you invested $10,000 in 3 bonds, one that matures in a year, another in 2 years, and the third in 3 years. When the 1-year bond matures, you can use the proceeds from that to buy a new 3-year bond. That way, you always have bonds coming due in 1, 2, and 3 years. And this creates a rolling cycle where a bond matures every year, giving you consistent interest payments and some protection against sudden changes in rates. Think of it like setting up financial dominoes. One falls every year, freeing up cash while you get to keep the rest of the ladder working for you. Now, with all that out of the way, what if you're already sitting on stocks in your portfolio? Is there a way to squeeze some extra income without selling them outright? Well, covered calls is the answer to your question. First, let's cover the definitions. And if you want an in-depth video about covered calls, check out this video up here. An option is a contract that gives the buyer the right, but not the obligation, to buy or sell a specified underlying asset at a specific price, known as the strike price, on or before a specified expiration date, in exchange for a fee known as the premium. A call option gives you the right to buy an asset, while a put option gives you the right to sell. Now, on the other side of the trade, the seller or the writer receives the premium in exchange for taking on the obligation to fulfill the contract should the buyer exercise that right. A seller fulfilling their obligation is called assignment. Covered calls are my personal favorite because it's one of the most straightforward ways to turn the stocks you already own into a cash flow machine. A covered call is a strategy where you sell a call option against 100 shares of a stock you already own. When you sell a covered call, you'll pick an expiration date and a strike price. The expiration date is when the option expires, and the strike price is the level that you want the stock to stay below by expiration. That's the goal. Now, if the stock does cross above the strike, you'll end up selling your 100 shares at that strike price. So in general, with covered calls, you want to set the strike at a high enough price that you'd be happy to sell your shares at. And there's the balancing act, right? The higher the premium, the lower the strike price, and the higher chance you'll get assigned. As an investor who prefers to hold on to my shares, I'd personally take a smaller premium in exchange for a better chance of keeping my stock. And that's the trade-off. Less upfront cash, but more control over your long-term position. For example, let's say you already own 100 shares of Johnson & Johnson. The stock today, let's say, trades at $177, and maybe you want to sell a covered call on these shares. The next thing you do is choose the expiration date for your trade and identify a strike price that J&J has a low chance of exceeding by that date. So let's say you think that J&J is not going to trade above $185 next month. To check the trade details for a $185 strike call, let's go to the company's profile page here on bar chart, then click on covered call on the left-hand side of the screen. Here, you'll see suggested covered call trades, including all of the details, plus option analytics and probabilities. I'm going to switch the expiration date here to October 3rd, which is 34 days away from the time of recording. And then I'm going to change the strike selection to show all. Once there, you'll see the suggested trades with different strike prices. For the $185 strike trade, the screener suggests selling a call for 62 cents per share, or $62 total. It also has a relatively low delta of minus 0.16, which means it's less likely to get assigned. And that's a key detail. A lower delta means a higher probability you keep your shares. And if you want more information on delta and other Greeks, you can watch this video up here. In terms of returns, for this trade, you'd be looking at a 0.4% return over the next 34 days. But that's 3.8% annualized. And with J&J having a forward yield of 2.9%, you could potentially be looking at a total return of 6.7% a year. That's like getting paid twice, once from the dividend and once from the option premium. And the risk? Well, it's relatively low. Worst case, if Johnson & Johnson trades above the $185 strike at expiration, you'll sell the 100 shares at that price. That's cash deposited right into your account. And remember, you already keep the premium. Now, you're not limited to selling covered calls on dividend stocks. Maybe you have growth stocks in your portfolio, like Microsoft or Nvidia, companies that pay little to no dividends. You can sell covered calls on them as well, and let me tell you, the premiums are very juicy. But let's flip the script for a moment. What if you have a little cash on the sidelines and you're waiting for the right time and the right price to buy a specific stock? Well, with a cash secured put, you get paid to buy stocks at a discount. It's true. Cash secured puts involve selling a put option on a stock and collecting a premium. Like the covered call, you'll pick a strike and expiration date, but there's a twist. Remember, with the covered call, the only risk is having your shares called away. With a cash secured put, your risk is being obligated to buy 100 shares of the stock if it trades below the strike at expiration. So you'll want to only ever sell a put on a stock you'd actually want to own, because between now and expiration, you can get paid to wait for the stock to drop to a specific price that you're comfortable owning it at. Think of it like getting paid to place a limit order. So let's say you're thinking about buying Nvidia and you think it's always too expensive. And today, let's say it trades around $174, but you'd be happy to own it at $160. Well, this is where you could generate a little income from the cash you already have and potentially get the opportunity to buy 100 shares of Nvidia at $160 a pop. So what do? Well, let's start by visiting Nvidia's profile page, select Naked Put from the Option Strategies selection, and then change the expiration date to October 3rd, for example, so we can see all the potential trades. With this trade, you can sell a put on Nvidia and receive $2.30 a share, or $230 total per contract. If Nvidia trades above 160 by October 3rd, then the put expires worthless and you keep the $230 premium in full. And by the way, you just got a 15.7% annualized return on your money. Not bad, eh? Then you can sell another to get a continued steady income while waiting for Nvidia to dip below your strike. The important thing about cash secured puts is that you have enough money to buy those 100 shares of the stock if you get assigned. You may also be tempted to use margin to sell puts. Most brokerages offer margin, but I'd avoid that, especially if you're selling options in retirement. I mean, this strategy works best if you're patient, disciplined, and only sell puts on companies you truly want to own anyway. So by now, you're probably wondering, are those the only strategies, or are there more ways to get paid from your investments? Income generation using options is not limited to covered calls or cash secure puts. There's also credit spreads like bull puts and bear calls, which generate income and work best if you have smaller amounts of cash available to invest. And I recorded an entire video about credit spreads, which you can check out up here. And then there's even more advanced strategies, which include iron condors, which combine two credit spreads and create a zone of profitability between the short put and short call strike prices. That said, only the covered call allows you to generate income directly from the stocks you already own. And that's why it remains one of the most popular choices for long-term investors like me. You can think of it like this. Dividends are the baseline paycheck. Covered calls are your side hustle, and strategies like spreads or iron condors, well, these are the advanced plays for those looking to maximize every opportunity. And there's a lot of income generating strategies that you can apply to your long-term portfolio. And the exciting part, you don't have to pick just one. The best investors combine them at different times out of the year. In a typical retirement portfolio, you'd want a mix of bonds, dividend stocks, and maybe even some option strategies to boost your income. As long as you understand the risks and weigh them against the potential rewards, you can build a portfolio that pays you a steady, reliable, and predictable income for years to come. So what's your favorite income generating strategy? Let me know in the comments below. And while you're there, be sure to like and subscribe if you found this video helpful. Well, folks, that's it for me today. Thank you so much for watching, and I'll see you next time.